Most people have never heard of BlackRock, yet its influence quietly shapes the world around them, what they see, what they buy, even how governments respond to crisis. We are taught to believe that power lies in presidents, parliaments, and prime ministers. But what if the real power sits somewhere else entirely? Above governments, beyond borders, untouchable. BlackRock manages over $10 trillion in assets, more than the GDP of almost every country on Earth. Through stakes in thousands of companies, BlackRock holds pieces of nearly every major corporation: technology, energy, finance, healthcare, and beyond. At the center of it all is Larry Fink. His annual letters to CEOs don't just offer advice, they quietly steer the direction of corporate policies on everything from climate change to social governance. His words ripple through boardrooms, stock markets, and industries worldwide. When the COVID-19 pandemic triggered economic panic, governments turned to BlackRock for help, tasking the company with designing bailout strategies and stabilizing financial markets. It wasn't elected officials making those calls, it was BlackRock. And that raises a simple but unsettling question. What happens when the people making the biggest decisions, the ones shaping the future of nations, are unelected, unknown, and unaccountable? BlackRock's rise didn't happen overnight. It began as a small risk management firm in the late 1980s, but through decades of quiet expansion, it became the most powerful financial institution in history. At the center of this story is Lawrence D. Fink, better known as Larry Fink. Born in 1952 in Van Nuys, California, Larry grew up in a Jewish middle-class neighborhood in Los Angeles' San Fernando Valley. His father owned a shoe store. His mother was an English professor. He was one of 3 children and met his high school sweetheart, Lori Wider, while attending Van Nuys High School. They married in 1974, the same year he earned a bachelor's degree in political science from UCLA. Fink later completed an MBA in real estate from UCLA's Graduate School of Business in 1976. Shortly after, he joined the First Boston Corporation, a New York-based investment bank. At First Boston, he became one of the firm's earliest traders of mortgage-backed securities, an innovative but risky financial instrument at the time. Fink was an overperformer, quickly rising through the ranks to become one of the youngest managing directors on Wall Street. Throughout the booming 1980s, his work added more than $1 billion to First Boston's profits, firmly establishing him as a major figure in the growing world of complex financial products. But in 1986, everything changed. One of his departments suffered a catastrophic $100 million loss after a wrong prediction on interest rates caused the value of their mortgage-backed securities to collapse. The loss not only wiped out profits, but also damaged Fink's reputation. By 1988, he was forced to leave. As he later put it, he did not have the option to stay. This failure became a turning point, sparking in Fink an obsession with risk management, an obsession that would define the philosophy of the company he co-founded later that year, BlackRock Inc. From the beginning, BlackRock set out to do something different. In 1988, alongside Charles Halleck and Bennett W. Golub, Fink helped develop a system that would become central to BlackRock's future, Aladdin. Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network, began humbly on a single workstation from Sun Microsystems, wedged between a refrigerator and a coffee machine in BlackRock's one-room office. Halleck, the system's initial architect, together with Golub, built the first mathematical models for mortgage securities, including collateralized mortgage obligations, an emerging and complex financial product at the time. Aladdin's first major test came in 1994 when General Electric asked BlackRock to analyze the troubled mortgage portfolio of its investment bank, Kidder, Peabody & Co., then considered one of the most complex portfolios in the world. With the help of Aladdin, BlackRock successfully navigated the task, and Kidder was eventually sold to PaineWebber the same year. Soon after, BlackRock began securing its first government contracts. In the late 1990s and early 2000s, Aladdin's advanced risk models were quietly adopted by several central banks and public institutions, drawn by its unparalleled ability to model financial risk and stress test complex portfolios. The success of Aladdin revealed something crucial. The risk models and analytics BlackRock had developed for itself were valuable to others. By 2000, BlackRock officially began offering Aladdin services to clients, opening a new business division that would become one of the company's most powerful assets. Today, Aladdin is far more than a financial tool. It is the invisible backbone of global markets, analyzing risk, pricing assets, and guiding decisions for nearly every major financial institution. Over 200 government bodies, central banks, and pension funds around the world rely on Aladdin to manage their portfolios and assess systemic risks, including the U.S. Federal Reserve, the European Central Bank, and finance ministries from across Europe and Asia. Aladdin didn't just help BlackRock manage risk, it helped the company embed itself deep inside both the private and public sectors. Its systems quietly oversee the movements of trillions of dollars, shaping decisions that impact economies at the highest levels. The secret to BlackRock's influence lies in its embrace of passive investing. Rather than picking winners and losers, BlackRock built massive index funds, buying slices of almost everything. Through this strategy, the company silently became one of the largest shareholders in nearly every major corporation on Earth. Today, through its iShares brand, BlackRock holds stakes in competitors across industries, all while remaining largely unknown to the public. But BlackRock's power extends far beyond the private sector. Its models, data, and algorithms are used by central banks, regulators, and treasury departments around the world. In times of crisis, whether the 2008 financial collapse or the COVID-19 pandemic, BlackRock isn't just consulted, it is brought in to design the response, to advise governments on how to spend, lend, and stabilize markets. This dual role, as both player and referee, has made BlackRock nearly untouchable, too complex to fully understand, too integrated to challenge, too powerful to ignore. BlackRock's reach is not limited to financial markets alone. Its influence touches governments, social policies, climate initiatives, and even the everyday lives of people who may never have heard its name. Through its enormous holdings, BlackRock wields quiet control over corporate behavior. Each year, Larry Fink's annual letters to CEOs lay out expectations for how companies should act, not just in terms of profits, but on environmental, social, and governance issues. These letters, though presented as guidance, effectively set the tone for corporate governance worldwide. When BlackRock speaks, companies listen, because in many cases, BlackRock is one of their largest shareholders. But BlackRock's influence doesn't stop at the boardroom. It has steadily extended into the highest levels of government. Several former BlackRock executives have quietly moved into key public positions. Brian Dees, who served as President Biden's top economic advisor, Adewale Adeyemo, who became Deputy Secretary of the Treasury, and Michael Pyle, who was appointed as Chief Economic Advisor to Vice President Kamala Harris. These are not isolated cases. They represent a growing pattern where the line between Wall Street and Washington blurs, raising questions about how much influence BlackRock truly holds over public policy and national decision-making. BlackRock's presence in Washington also comes with heavy lobbying spending. The firm consistently ranks among the top spenders in financial sector lobbying, funneling millions into efforts to shape legislation and regulation. Its influence was particularly notable during discussions surrounding the Dodd-Frank Act, where BlackRock lobbied on provisions affecting asset managers and financial risk oversight. The global financial crises have only deepened this dependency. In 2008, as markets collapsed, governments turned to BlackRock for stability and expertise. The same happened in 2020, when the COVID-19 pandemic crashed economies around the globe. BlackRock was tasked with helping the U.S. Federal Reserve manage emergency asset purchase programs, effectively deciding which sectors would receive life support and which would be left behind. This unprecedented role, simultaneously managing private investments while advising public institutions, raises profound ethical questions. Is it possible to serve both the market and the public interest without conflict? Critics argue that BlackRock's immense concentration of power poses systemic risks. The risk of political capture, market distortion, and the erosion of democratic oversight. Supporters, on the other hand, claim that BlackRock's scale and technology bring efficiency, stability, and long-term vision that traditional governments or smaller firms cannot match. Yet beneath these arguments lies a deeper issue: accountability. BlackRock operates in the shadows of the public sphere, where its decisions, however well-intentioned, are insulated from democratic checks and balances. What happens when the most powerful financial entity on Earth answers to no electorate, no voters, and no borders? In the end, the story of BlackRock is not just about money. It is about power. The power to shape economies, to influence governments, and to quietly steer the direction of the modern world, without ever needing the public's permission to do so. BlackRock's influence extends far beyond its vast portfolio. Its reach into the corridors of power and its significant ownership stakes in major corporations raise critical questions about the intersection of finance, government, and corporate interests. During the 2008 financial crisis, BlackRock was called upon by the U.S. Treasury and the Federal Reserve to assist in managing and analyzing distressed assets. This involvement positioned BlackRock as a key player in the government's response to the crisis. In 2020, as the COVID-19 pandemic triggered economic turmoil, BlackRock's role expanded. The Federal Reserve enlisted BlackRock to manage the purchase of corporate bonds and other assets as part of its emergency lending programs. This included overseeing a portfolio that could reach up to $750 billion, effectively placing BlackRock at the center of the government's economic stabilization efforts. BlackRock's investment strategies have led it to acquire significant stakes in some of the world's largest companies. As of recent reports, BlackRock holds approximately 7.2% of ExxonMobil's shares, making it one of the company's largest institutional investors. The firm also owns about 7.4% of Lockheed Martin, a leading defense contractor, highlighting its substantial influence in the defense sector. BlackRock is also a significant shareholder in major technology firms, including Apple, Microsoft, and Amazon, reinforcing its pervasive presence across various industries. BlackRock's lobbying efforts are notable. In 2020, the firm reported spending $1.83 billion on lobbying activities, with a focus on finance and taxation issues. This expenditure underscores BlackRock's proactive approach to influencing policy decisions that impact its operations and investments. The firm's lobbying activities have been particularly evident in discussions surrounding financial regulations. For instance, during the implementation of the Dodd-Frank Wall Street Reform and Consumer Protection Act, BlackRock was among the many entities lobbying to shape the final regulations. The dual role of BlackRock, managing private investments while advising on public policy, raises significant ethical concerns. Critics argue that the firm's substantial ownership in key industries, combined with its advisory roles to government entities, creates inherent conflicts of interest. The potential for policy decisions to favor BlackRock's private holdings over public interest is a matter of ongoing debate. Furthermore, the revolving door between BlackRock and government positions adds another layer of complexity. Former BlackRock executives have held influential roles in the U.S. Treasury and the Federal Reserve, blurring the lines between private financial interests and public policy making. BlackRock's unparalleled influence in both the financial markets and government policy-making positions it as a central figure in contemporary capitalism. Its extensive ownership of major corporations, significant role in government economic interventions, and active lobbying efforts illustrate the growing convergence of private financial power and public governance. As BlackRock continues to expand its reach, the questions of accountability, transparency, and the balance of power between private entities and democratic institutions become increasingly pertinent. The story of BlackRock is not just about a financial firm. It is a reflection of the evolving dynamics of power in the modern world. The public doesn't vote for BlackRock, yet it wields enormous influence over policies that shape economies, wars, and societies around the world. Some describe this as a form of benign dictatorship, when a single entity becomes too big to fail and too big to challenge. BlackRock's reach is so vast that governments, markets, and even competing corporations rely on its decisions. Through its environmental, social, and governance activism, BlackRock shapes corporate policies that affect energy industries, pushing major shifts in how companies operate worldwide. Its ownership stakes in defense contractors indirectly influence military priorities, blurring the line between private investment and public power. BlackRock's influence extends beyond Western borders. In China and other non-Western governments, it operates quietly but strategically, navigating complex political landscapes and expanding its global footprint in ways rarely covered by the media. What we see today is not just a company, but a merging of state power and corporate power into a single, opaque structure, one that operates beyond the reach of traditional democratic oversight. This raises a fundamental question. When power no longer needs to be seen, no longer needs to be legitimized by the people, what does that make democracy? As BlackRock quietly shapes the future, the answer remains uncertain. But one thing is clear: the dynamics of power have changed forever.